welcome to another day of the PM revision session, to the last day, I would say. And in this session, we will be looking at syllabus part E, which is performance, measurement, and control. And then some key topics with it. And finally, we would be looking at some exam techniques and other exam-related discussions as well. Okay, folks, so that's basically the agenda for the day. So let's get started, shall we? So the first and foremost thing that we have to learn when it comes to this particular syllabus area is what is performance measurement and how is it different from performance management? Okay, folks, performance measurement is all about, like measuring the extent to which we have achieved our objective. Okay, folks, how is it different from performance management then? Performance management is, as the concept suggests, is when you set an objective for the organization, right? And then you implement a strategy to achieve that organization, right? So the day-to-day management of that company to achieve that organization is known as performance management. Whereas, the extent to which we have measured the, performance of the organization using ratios, using non-financial measures, right? Using several other aspects, right? That's basically what performance measurement is all about. Performance measurement is primarily focused on controlling, okay, folks, rather than planning. Okay, folks, that's basically the idea. And then, it establishes how well something or somebody is doing against the plan as well, right? That's basically the aim. It's for controlling itself, right? We compare the actual performance with the plan and then see to what extent we have deviated. Are we in line with the plan? Are we achieving our objectives, right? So that's basically the idea. And of course, there are two types of measures that are there. There are financial measures as well as non-financial. Financial measures are kind of easy if you think about it, right? It's just the ratio analyses that that you have learned, right? Profitability ratios, for example, gross profit margin, net profit margin, EPS, return on capital employed, right? Gearing ratios like debt to equity, right? Operating gearing as well. That's also important. What is the equation for operating gearing? Basically, contribution divided by profit. Okay, folks. Or in other words, it's also can also be calculated as fixed cost divided by total cost as well. So the more fixed cost that we have in an organization, the higher the operational risk would be. Okay, folks. And what about for gearing ratio? Gearing ratio indicates the financial risk, right? Right. Financial gearing indicates the financial risk, whereas operating gearing indicates the operational risk, right? So for operational risk, the more fixed cost that we have, the higher the risk, and for financial risk, the more debt we have as compared to equity, the higher the risk. Okay, folks, so that's basically the interpretation, right? It's important. It's always important to learn the interpretation, guys. Do not forget it. See, equations are something that you guys already know, right? You can all revise them on your own as well. But one key thing that you have to remember here is the equations. Is the interpretation of those equations. Okay, folks. As I have mentioned throughout my lectures, like multiple times, like a broken record, right? So, it's not about pointing out that, hey, this particular value has increased or decreased. Anyone can do that. You don't need an ACCA qualification to point out and say that, hey, this particular number has increased from previous year or decreased from previous year, right? But it takes a professional to identify what caused that. Okay, folks, what exactly was the event in the scenario that has caused that particular increase or decrease? This is what you have to explain when it comes to the exam. Okay, folks, just keep that particular point in mind. Don't just plainly write, the ratio has increased or decreased and expect the examiner to give you marks. Always explain why. Why exactly has it decreased? And I can tell you 100% of the time, or I would say 99.9% of the time, just so that I'm not giving you any guarantee, because I'm an auditor, I don't give guarantees, I just give assurance. Okay, folks, so I can tell you that 99.9% of the time there would be some scenario information that can be linked to the change in ratios. Okay, folks, so that's basically the idea here. So always remember to find a way to interpret that particular ratio as well. Find the information that causes the a particular ratio to increase as well. Okay, folks, just remember that. And then we also have the liquidity ratio as well, which is current ratio, quick and asset test ratio. What is the difference between current ratio as well as quick and asset test ratio? For current ratio, the equation is current assets divided by liabilities, current liabilities, right? And whereas for asset test ratio or quick ratio, the equation is current assets minus inventory divided by current liabilities as well. Okay, folks, we're excluding inventory because for some organizations, inventory is a slow-moving asset and therefore cannot be considered as a current asset. Okay, folks, that's basically the idea. Accounts receivable, payment period, payables, payment period, and inventory turnover days as well. It's always important how you interpret each of these particular ratios as well. And yeah, that's just it. Okay, folks. So these are just the key ratios. Of course, there are a number of other financial ratios which you can use in order to assess the performance of an organization. Depending upon the scenario information, carefully read through all the scenario information and think of the ratios. Okay, you think of what all ratios can you use in a particular scenario and then interpret it accordingly. Okay, folks, so remember that. And then we have not-for-profit organizations as well. So when it comes to not-for-profit organizations, what do? We use the 3 E's of economy to measure it, right? So the 3 E's of 3 E's of value for money are basically E, economy, E, effectiveness, and E, efficiency as well, right? So economy, efficiency, and effectiveness, right? That's basically the criteria that we use in order to measure the performance for a not-for-profit organization. And why is that? Because when it comes to not-for-profit organization, we don't have any financial information available, right? We just don't have any financial information, or the amount of financial information available would be very limited. They don't have revenue, they don't have profits, right? We can't calculate the gross profit or net profit ratio or the conventional ratios that there are, right? Which is why we use the 3 E's, okay, folks? So for not-for-profit organization, the nature of their objective would be of a non-financial nature. And the information that we have to assess performance will also be of a non-financial nature as well. So as professionals, what we have to do is we have to apply the value for money concept, okay, folks, and then ensure that, and set up targets or set up measures for each of the E's, economy, efficiency, and effectiveness, and then assess the performance accordingly. Now, what does economy stands for exactly? Economy is all about getting the inputs at the most reasonable cost possible, right? That's what the first E for economy stands for. Secondly, we have efficiency, which is getting the maximum output from the minimum input, right? That's what efficiency is. And then effectiveness. Effectiveness basically means that you have to achieve certain targets and goals. Okay, folks, there would be certain goals and targets that are set for each organization. So, are they achieving it or not? That's basically what we have to measure. Okay, folks, so that's basically the idea here. So yeah, that's basically what the value for money concept is all about. And then we talk about different types of stakeholders as well. So how many stakeholders do we have? We have internal stakeholders, right? Which are those stakeholders that are, who are stakeholders exactly? People who have a certain degree of power or interest over our organization, right? Or to state in a bit more specific manner, those people who have an influence in the organization. That's basically the idea. So there would be internal stakeholders. Those are basically stakeholders within our organization, such as employees, management, etc. Right? Then there are connected stakeholders, for example, the shareholders. Right? Those people who are connected, to the organization using a contract or something. Right? And then there's of course external stakeholders as well, as in people who rely on the organization as well, such as the community, such as the government, right? Tax authorities, etc. Right? Banks, right? Those kinds of people. And some more examples of connected stakeholders would be suppliers and customers. They also have a contractual relationship with the client, right? With the organization, right? So we call them connected stakeholders as well. Okay, folks, so those are just some types. And of course, moving on to the really important, model that we will be learning in this particular paper, which is basically the balance scorecard. Okay, folks, so what is the idea behind the balance scorecard? We're trying to assess the performance of an organization, especially a manufacturing organization, from both the financial perspective, the non-financial perspective, both internal aspects as well as the external aspects as well. Okay, folks, so that's basically as to what the balanced scorecard approach is all about. It looks at 4 perspectives, right? What are these 4 perspectives? Basically, the customer perspective, finance perspective, internal business process perspective, as well as learning and innovation perspective as well, right? So we have a look at, we think of the organization from each of these 4 perspectives and see how exactly are we adding value to the customers, how exactly are we adding value to the shareholders, making more profits and, increasing the finance, right? How exactly are we bringing in efficiencies within our internal business processes? and what are we doing to grow ourselves, to innovate in our production, right? All these things, right? So that's basically as to what balanced scorecard approach is all about. There can be questions where you have to apply the balanced scorecard approach. Remember, guys, writing the definition does not give you many marks. Okay, folks, hardly it gives you 1 mark, max to max. It looks 1 or 2 marks. That's just it, right? But more and above that, in order to score more, you have to speak from the scenario. It's always important. Okay, folks. In the exam, the scenario is the key thing, right? So read through the scenario carefully, understand the story behind it, and think logically from that scenario perspective as well. That's really important. Okay, folks. So just keep that point in mind. And of course, there can be MCQs as well, but primarily these kinds of questions are listed as a section C or case study questions. So be very mindful of that. Okay, folks, now moving on. So the thing about balanced scorecard is that they primarily focus on manufacturing organizations, so those organizations that have a tangible product, right? But when it comes to service businesses, okay, folks, when it comes to service businesses, we can use the Fitzgerald and Moon's building block model as well. Okay, folks. So when it comes to this particular model, there are 3 building blocks when it comes to a service business, right? There's the dimensions of performance. There's the standards, and then there are rewards as well, right? So what does dimensions of performance stands for? Well, in dimensions of performance, to assess the performance of a service business, we look into these 6 aspects. Okay, folks, what are the 6 aspects? Profitability, the financial aspect, right? That's basically something that we look into. Like, are they making profits? Are they creating dividends for the shareholders, etc.? The quality of the service that they provide. How good is the quality? Like, is it acceptable by the stakeholders and everyone, right? And innovation is also another aspect which we look into, as in, are we innovating, right? Are we responding to the increase or changing taste? Are we creating differentiating services which are different from our competitors, right? So this is what we look at, innovation. Flexibility, I know a lot of students are confused about flexibility. Guys, the idea about flexibility here is, are we able to respond according to the customer's taste and preferences? Okay, folks, if the customer says that, hey, do this, then are we able to, do that as quickly as possible, right? That's what flexibility means here. Okay, folks. And then we have competitiveness as well, right? How competitive is the industry? How far are we, as compared to our competitors, market share wise, etc., right? And then finally, resource utilization as well. Are we using all of the resources that we have in our service business to the best extent possible is what we're referring to over here. Okay, folks, simple as that. So that's what the division of performance is all about as well. So that's the first building block. What about the second one? The second building block, which is standards, tells us about how exactly should targets be set, or what should be the nature of the targets or standards that are set, right? So, what all things do we look at? Ownership, right? If you're setting the targets, people who are trying to achieve the target should feel like they own the particular target. Okay, folks, they can definitely do this. They can own it, right? That's basically something. Secondly, is it achievable, right? Like, we should not set the bar too high, right? So what happens if you set the bar too high? Then people will get demotivated that, hey, like, they're setting the bar too high. It's just not achievable. So I don't know what we're dealing with here, right? So that's basically the idea. People would get demotivated, right? So we should set the target at the achievable level so that, people are motivated to achieve it as well. And then finally, equity as well. Okay, folks, standards should be set in a fair manner. Okay, folks, we should not, set unrealistic standards that people cannot achieve is what we're trying to say. Okay, folks, so I can't expect to, work a particular individual for 25 hours per day, right? Because there is no 25 hours per day, right? So that's basically the idea. It should be set in a fair, achievable, and then people should feel like they can own the target as well. Okay, folks, that's basically the idea. Thirdly, we also have rewards as well, right? So when it comes to rewards, what all things do we look at? We look at clarity, right? How, as in the reward scheme, right? See, people should be rewarded for the work that they're doing, right? So whenever they are, getting rewarded, we should ensure that it is clearly communicated how the people are rewarded. Okay, folks, the organization should clearly communicate how exactly will the, staffs or employees will be rewarded as well. And then it should be motivating, of course. The reward should not be so low that we're demotivated to work, right? So that's basically something. And thirdly, controllability as well, right? So people should be rewarded for only those things that they have a certain degree of control over, is what we're trying to say. Otherwise, it will be unnecessary force for the company. And if you think vice versa, right, as in, if we don't reward employees, for, let's say, the market downturn or something like that, then that's only going to demotivate the employee, right? And is the market downturn something that the employee can control over? No, not really, right? So that's basically the idea. Okay, folks. So rewards should be clearly communicated, should be motivating, as well as it should be controllable. Okay, folks, it should be something that the employees have a certain degree of control over as well. So yeah, these are the 3 building blocks of Fitzgerald and Moon's building block model. So remember these concepts. It can be tested as an MCQ as well as case study questions as well. Okay, folks, so remember that. And then we move on to divisionalization, right? So what's the idea here? We're dividing the organization into multiple divisions, right? That's basically the concept over here. There are certain advantages and disadvantages in doing so, right? Advantages are that the divisional managers will be delegated more authority, so that they can take their own decisions, and therefore they will be motivated to increase the performance of each of their departments. Okay, folks, that's one of the key advantages. Disadvantage includes things like duplication of work, divisional competition. Divisional competition means that each manager would say that, hey, maybe my division needs to perform better as compared to the others, right? So that's such a kind of competition can come up as well. And then there's return on investment as well, right? Return on investment as well as residual income, right? Remember the equations and everything and how you interpret it as well. So when it comes to return on investment, what's the idea? PBIT divided by capital employed, right? So how much profits am I getting from the capital that I've invested? That's basically as to what it means, right? And is there any advantages? Most definitely yes. It's a comparable figure, right? Since it's a percentage figure, it's good for comparison purposes, definitely. Okay, folks. Is there any disadvantage? Yes. One of the key disadvantage, and I can guarantee you that it would be tested somewhere in the exam, right? Is that it demotivates people, or to be more specific, it demotivates managers to make long-term decisions for the organization. Okay, folks, because if they take, let's say, a capital investment decision or something like that, what would happen to the ROI? The ROI will decrease. Why? Because the capital employed will increase. If I'm making a capital investment, capital employed will increase, therefore decreasing ROI. Therefore, managers would be demotivated to make these capital investments and long-term decisions, so they always push these maybe for the next year. Okay, folks, so that's basically the idea. So that's what ROI is all about. So just keep this in mind. That's a really important point that can be tested in the exam. So remember that. Okay. And then for residual income, what's the idea here? What is the equation again? PBIT minus imputed interest charge, right? That's basically the idea. Or operating profit minus imputed interest charge, right? Imputed interest is basically capital employed times cost of capital, to put it very simply. So measures of center's profit after deducting the notional interest cost. That's just there. Okay, folks. And again, this is an absolute figure, right? Advantage is that we would be able to understand what is the exact residual income that is left over after all the expenses and all the investments and everything. Okay, folks. So that's basically the idea. And disadvantage is that it's not comparable or anything, since it's an absolute measure, right? But then again, we still get an exact amount of what's left over, or what is the residual amount, right? So that's basically something to keep in mind. And of course, finally, we move on to one of the craziest topics that are out there for some students, right? Not all of them. It is kind of easy if you think about it, but still, some people still find it kind of difficult as well. So, the topic that I'm talking about is basically none other than transfer pricing. Okay, folks. So when it comes to transfer pricing, what is the idea here? It's basically whenever we trade internally, there's a price that needs to be set between divisions, right? Division A and B, right? So this particular price is known as transfer price, right? And how do we determine that exactly? So guys, transfer price is basically can come between two regions or two limits. Okay, folks, what are these limits exactly? Minimum, the supplying division's marginal and opportunity cost. Okay, folks, so the minimum amount would be the supplying division. Who is the supplying division? The seller, right? If A is selling to B, right, A would be the seller, right? So A's marginal cost plus an opportunity cost. Okay, folks, A's marginal cost plus opportunity cost is one limit. And then secondly, so that's a minimum price, right? And secondly, the maximum price of transfer price would be lowest of market price, less internal saving. Okay, folks, the selling division. Okay, folks, the selling division would say that, or B, the buyer would say that, hey, the maximum price that I can give you is the lowest of the market price of the product, less any internal saving cost. Because since we are selling internally, there's no need for some beautiful packaging or stuff like that, right? So you can avoid that and save some cost there. So definitely, those kinds of costs can be saved as well, right? So therefore, the minimum limit would be the lowest market price less any internal savings cost as well. Okay, folks. So that's basically the two designated situation or limits. Okay, folks. The minimum and maximum limit for transfer pricing. This is it. Okay, folks. This is basically what is helpful for you in order to determine the transfer price of the product as well. Okay, folks. Remember, guys, whenever you are given with the transfer pricing scenario, think from that scenario's perspective and try to understand like what exactly is going on over there, what are the informations that we have, etc., and then think using these rules accordingly. Okay, folks, this is like the general rules. So yeah. And of course, the opportunity cost that we talked about, what does that mean exactly? The opportunity cost would be contribution foregone by internal transferring than selling externally. Okay, so if you already had a external market price for that particular product, let's think from Division A's perspective. Okay, folks, for the seller's perspective, right? I already have an external market where I can sell this product, right? But by selling internally, I am sacrificing the profits that would have been foregone or contribution that would have been foregone from selling externally, right? So that's basically the one opportunity cost. Or in other words, let's say that there is no external market, right? There is no external market for the product. Then the contribution foregone by not using facilities for the alternative use. This product would have had an alternative use for it, right? So since I'm not using it for that alternative use, I'm sacrificing the contribution which I would have received from the alternative use as well, right? So that's basically my opportunity cost over here as well. Okay, folks. So yeah, that's basically it. That's basically all about syllabus parts E, which is like the last syllabus area, and we've covered, I guess, all of the key topics that are there in the PM paper from a theoretical perspective. And as I mentioned in the previous days as well, okay, folks. So calculations are also important. So just practice at least the easiest calculation so that you can retain your memory about those concepts as well. Okay, folks. Continue practicing more exam standard questions as well as past paper questions that are available in the ACCA CBE platform as well, that can really help you when it comes to the exam as well. Okay, folks. And speaking more from the exam perspective, remember, guys, it's always advised to have a conservative approach here, because for section A and B, I would highly suggest that you finish the exam, finish the section A and B portion, which is the MCQs and OTQs, within a time period of 1 hour and 40 minutes, max to max. Okay, folks, finish the section A and B for within 1 hour and 40 minutes, max to max. Okay, folks, and for section C, take another 1 hour as well. And ensure that you have at least 10 minutes of buffer time as well in the end to see where all can you add value or where all can you score more marks. Okay, so that's basically the approach. So for section A and B, 1 hour and 40 minutes, and for section section C, you need to take around 1 hour, max to max. Okay, so go by this threshold. Let's see what happens, right? As in, maybe you might take 2 or 3 minutes extra, maybe 5 or 6 minutes extra, but you still have that buffer time. I'm just keeping some buffer time so that so that in case there's some difficult question or something, you can use the buffer time on those. Okay, folks. So that's basically the idea. And of course, not all questions will be difficult. I can guarantee you that, as in, not all questions in the exam is difficult. If you find all questions to be difficult, then you haven't prepared well. That's basically the answer. Okay, folks. But but one thing that I can guarantee is that after going through all these syllabus and everything, right? The questions that can come up in the exam, like there would be difficult MCQs and then there would be easy MCQs as well. Okay, folks. So even if you take, let's say, a few minutes extra for one difficult MCQ, don't worry, because you can catch up with some easy MCQs as well. Okay, folks. So don't worry about that. But don't take too much time. I would say a threshold would be max to max 5 minutes, and then even if you want to extend slightly about that, 8 minutes. Okay, folks. Nothing more than 8 minutes. So remember that for one MCQ. I'm talking about MCQs here. Okay, folks. Remember that. Alright, so yeah, that's basically it. That's basically all I wanted to cover throughout this particular revision session. Of course, if you have any questions at all, feel free to let me know, and I'd be happy to take up that particular question on the spot as well. Okay, folks. So yeah, thank you guys. Thank you so much for joining in, and I wish you all the very best for your upcoming exam.